afternoon, everyone. Thank you so much for joining another Barometer Readings webcast, and happy Halloween to everyone out there. Dave, it looks like you're dressed up as a portfolio manager. How original. Guys, we're always happy to have you on our weekly call. And on today's webcast, we would be pleased to provide a brief macro overview and, of course, address your questions at the tail end of the conversation. So don't be shy. You can email, don't email me. Send your questions to the Q&A or the chat on the Zoom link, and we will get to your questions as soon as Dave wraps up your call, his conversation. And on that note, we will turn the conversation to the one and only David Burrows. Good afternoon, David. Happy Halloween.
How are you?
Great, thank you.
Hopefully everybody's gonna get some treats tonight, not some tricks. I'm gonna go out, trick or treating right after this. Thanks everyone for joining us. Here we are at the end of October. Generally, I'm pretty happy when October is over. We know what the seasonality is. There's all kinds of studies out there as to how the market does in November and December, when it's been positive to the end of October. Market's been under pressure really since the 26th or 27th of July, in some pretty typical seasonal weakness. So the question is, where do we go from here? Is anything changing for the better, for the worse? And where is the leadership? Is there anything new emerging? Are there any groups rolling over? And we'll try and touch on all of that as we go through. We always work from a fairly high level, keeping it sort of at a macro 30,000-foot view, and then drilling down into some very specific themes. From an asset class perspective, we continue to believe that we're in a structural bull market. Certainly everybody's patience is being tested, but what we've been through since December of 21 is really fairly typical, sort of mid-stride in a 15 or 18-year secular bull market. We can all think back to what happened in 1990-91 in the middle of the bull market of the 80s and 90s. It was a very tough time. Lots of things to worry about. Real estate was under pressure. Interest rates had ramped up, and 20 months later, market turned and made another new high, and then rallied like crazy until we got the 1994 slowdown. So these things happen. When we look at it, the last two bull markets, this is what we've been going through here. It's been the largest point of decline was about 27%. 1990-91 was at 21%. Lots of corrections along the way. The thing we don't want to see is something like 2000 to 2003 or 2007 through 2009, 57.7. That's a completely different ball game. As we sit currently, a lot would have to change to get us to that point. S&P is held nicely along the way. When we look at the shorter term chart, this is the beginning of the bear market in December 22. We've held this channel, all the way since October. We did dip down below that channel, and so I think that's been a cause for concern. We've been looking at sort of the leadership groups, and as it sits, there doesn't seem to be a lot of change, although there certainly was a pretty steep drawdown in the sectors that were lagging on the year as we've come into the end of October. For those that don't know, October 31st is year end for a very high percentage of mutual funds in the US. So there is tax loss selling that does take place into the end of October. And certainly the weaker groups over the last 2 weeks, especially the defensive sectors, really were under pressure. So if we were to look at the equal weight S&P, it's been tougher on the average stock than on the broad index itself. Now we talk about the fact that you tend to get sort of 10% correction a year. S&P, sort of top to bottom down 10.6%. And, here we are moving out of October. So the question is, are there things that we can see in the chart that point to something changing for the better? We'll touch on that. Outside of the US, a few global markets have continued to chug along. We've talked a lot about Japan over the last couple of years. Japan really has come smartly out of a bear market going all the way back to 1991. This is relative strength versus the S&P. You can see it's been on a tear and continues to be. We're at relative strength new highs today, with the Japanese yen weakening through the 150 level. And that certainly isn't hurting Japanese stocks. When we look at India, it's a very similar picture, trading better than 88% of companies in the S&P on the year. The EPI is up a little over 10% on the year, and has certainly held up well as we've been going through pullback here in North America. In the fixed income markets, we've been under pressure. 10-year yields moved smartly higher off the lows in 2020. It's about the sharpest, fastest tightening in rates that we can point to, even compared to the beginning of the last bear market, long-term bear market in bonds. And I think people will point out that it would be rare for rates to move straight up and then keep on moving up. Certainly, just like on the way down, we move down in fits and starts, lower lows and lower highs. On the way up in the 50s and 60s, up in higher highs and higher lows. Now, there's a lot of debt in the system, lots of concern about the US federal deficit. But let's be clear, it would not be the US bond market that would show a problem first. If there was going to be problems at the sovereign level, you would see it in some of the weaker countries that have a much higher percentage of debt relative to GDP, and it's probably not going to be the US. So we probably should expect at some point we get some kind of a bounce in the bond market. And we, as you know, have been very bearish on bonds. This is the 10-year yields, moving off the lows in 2020. And really, these are monthly bars. So, this month, again, yield moved higher. We moved through 5%. However, a couple of things that do stand out to me. First of all, as the aggregate bond index in the US took out the lows from last October, it's interesting to see how some of the oscillators are having a positive divergence. In other words, we made a lower low in price, but we're not seeing the same low in momentum. It's possible bonds are getting to the point where maybe they can make a stand. We highlighted a while ago that yields had become very overbought. While we weren't prepared to make any large allocations, certainly it's something that we've been watching. TLT is doing the same thing. That's the 30-year bond ETF, again, became exceedingly oversold like it did last October. And a couple of things to take away here. The speed at which bond prices move lower puts fear into all portfolio managers. Nobody likes to see a big liquid asset class move in price as rapidly as this one has. Now, look what happened when the pressure came off last October, beginning of November, when bond yields bounced from an oversold level. You had a good month, a good series of weeks higher in price, and that certainly helped put a bid into stocks. Now, we're noticing this divergence coming about here. It's not impossible we could get a bounce, even up sort of a few dollars, and that would certainly help. So that's one thing that we're watching as to what might be helpful for stocks. And to be clear, since yields bottomed in 2020, even though we've had both good equity markets and correcting equity markets, equities have continued to hold a bid relative to bonds all the way through. So our focus has been on stocks, not on bonds. I think that continues to be our call. If we were to see improvement in the bond market, it probably would play even better in the stock market, but we'll see. But something just to keep an eye on. Similarly, if we look at equity dividend growers, and we talk about dividend growth as being an important theme in rising rates, we have continually seen dividend growth, the equities, outperform the bond market. And frankly, in many ways have outperformed stocks and high dividend paying stocks over the same period of time. So this continues to be, in my opinion, the most important secular theme for a broad base of investors. And we've been very focused on identifying dividend growers, and they have held up well through some of these corrections. Excuse me. Moving on, commodities. Second leg of the bull market, is in gear. We moved higher when the economy started to reflate and inflation picked up. Commodity prices broke out of the bear market they've been in since 2008. They consolidated through the course of the period where everyone thought the Fed was going to continue to tighten. And as the market started to sense that the Fed could be close to done, you saw commodity prices start to move higher. So whether we're looking at them relative to bonds or whether we're looking at them relative to stocks, versus the equally weighted S&P, commodities is an asset class you really cannot ignore. And I recognize how unpopular it is, but as we've talked about, once strength begins, it tends to go on for quite some time. So we'll see whether the commodities producers can participate in this next leg of the market. So our job isn't to be everywhere. Our job is to be targeted. Our job is to identify themes where, due to some structural tailwind, prices start to get revalued. And when it starts, especially in a group that has been underowned, it can go on a long time. Not only do you see earnings grow and see dividends grow, but you see the multiple that the investors are prepared to pay go up as they start to change their view on that part of the market. So we're always identifying and working on identifying market leadership. We don't have to be everywhere. We're paid to generate a return, not to be invested in a broad-based market. If you want the S&P, certainly go buy the spider, and don't pay a fee for that. We're always trying to recognize new leadership as it emerges, or old leadership as it rolls over, so that we can keep the portfolios in tune with market, and we are always prepared to play defense. Now, that's been important. When our breadth models are showing weakness, we don't do a lot. We tend to sit on our hands. And we've talked every week about what the breadth models have been showing, and really since the beginning of August, we've seen deterioration in the average stock. So the percent of stocks in uptrends, percent of stocks trading above their 50-day moving average, percent of stocks trading above their 150-day moving average, which meant we've sit on cash. And as we've been stopped out of position, the cash position has grown. So as of last week, we were about 30% cash and short-term bonds. It's about the same as we speak today. No new sizable leadership showing up. Our job is to be tactical. And while we think that the calendar ultimately is in our favor, we need to start seeing change in some of those underlying metrics. Those metrics are driven by looking at breadth across sectors and themes and geographic regions to try to identify those that are seeing an improving number of equities or securities performing well. When breadth is expanding, a higher and higher percentage of securities participate, it means that money's getting put to work. When we see deteriorating breadth, it means that money's leaving that group. And while the leaders may look good, if the average company underneath the surface is weakening, that's a cause for concern. So we're always trying to target those areas of market leadership. Sometimes there's just a few, sometimes there's lots. And then we populate trying to find specific securities that meet our business tests, things that are good getting better. We don't ever want to buy something that's broken, hoping that it's getting fixed. We want to find companies that we can see in the income statement and the balance sheet, something's changing for the better, and that price is behaving the way it should be, given what we think we know. If the fundamental characteristics are improving, hopefully accelerating, and the price action or the technicals are improving as well, those two things are in sync in groups that are seeing net improvement breadth. That's where we want to be. Now, to the extent that we get the portfolio perfect, great, but that's not generally the case. We're always making small mistakes. We need a really disciplined selling strategy, so we use stop losses on every position. Our job is to make sure that little mistakes don't turn into big ones. At the market level or at the sector level or thematic base, we're always looking for groups that have become underowned, where the leaders start to turn higher first, and where over time a higher and higher percent of securities within that universe are performing well. That's expanding breadth. There's no bear market in history ever took place while breadth was expanding. And so in a world where everybody's looking at, say, an ETF for what the price action is, doesn't tell you what's happening under the surface. We want to know when the weaklings start to fail, because it tells us that selling could pick up in more and more securities and breadth could go the other way. Okay, so from a high level, last week we talked about the fact that our key long-term indicators for Canada, for the US, and globally had been seeing the percentage of stocks performing well deteriorating. So in the NYSE, for instance, now about 28% of stocks are in uptrends. Now, that doesn't mean that there aren't companies that are performing well. It just means there's a small percent, and that number has been dwindling. Now, when we get to 30%, generally that's some time to sit up and take notice, because it doesn't happen all that often, and that's where the opportunities come. But we need to see the beginning of improvement, or the percent of stocks and uptrends start to expand before you want to put money to work. Similarly, when we look at, for instance, the percent of stocks trading above their 50-day moving average, it has now become exceedingly low, like very relevant. Now, we haven't seen it turn up yet, but we're getting to that point. Interesting enough, at the end of October, where typically we see things start to improve. Percent of stocks with positive weekly price momentum, percent of stocks make new highs. All of these things are washed out. So now let's just try and make a couple of insights. This is the percent of stocks in uptrends in the NYSE, and this goes back to 2006. So we're going back a fair way, 17 years. You can see that when the market made its low in October, so the 9th month, September, in October, the percent of stocks in uptrend reversed up. This was last year in 2022. It happened from 18%. Okay, if we go back to 2020 in December, we got a reversal up the first week of January from an exceedingly low level after a terrible sell-off in the fall of 18. Okay, so sorry, 2020, that's the COVID low. That's the 2018 low in December, turning up in the first month, January. This is the low in 2016, turning up in the second month, February of 2016. So when we get below 30%, it tends to be important to watch for a reversal. We aren't seeing a sign of it yet. However, when you look at the percent of stocks trading above their 50-day moving average, it did turn up early in October. And when it did, we said, look, these can often retest the lows. And that's exactly what we've done. So percent of stocks trading above their 50-day is at 14%. Look, go back over the last several years. This is where things tend to bottom out. And importantly, it tends to happen in the fall. So we watch. When we look at the percent of stocks with positive weekly price momentum, so this is upward trajectory. This is interesting, because in fact, we hit the lowest level in August. Then it turned higher in September, turned back down in October, and made a higher low. Then turned higher again and pulled back. And as we sit right now, today, it's very close to reversing back up into a column of X's, meaning that as the market has made lower lows, actually there have been fewer stocks making lower lows. It's actually been some of the very biggest tech stocks that finally pulled back towards the end. Now, it's rare that a significant correction goes by without the leaders getting hit. But I am interested to see that the worst point from a momentum standpoint was in August, a higher low in October, a higher low as the index was making its lower low. That's a divergence. That's something that's changing under the surface that points to a positive change. So you can see that as of yesterday, 3% of companies had reversed back up into positive momentum. Today, my guess is there will have been enough change to turn this higher, but we'll see. So under the surface, some important changes. Now, from a sector perspective, as of the 23rd, a week ago, the average sector had 26% of stocks in uptrends. As of this morning, 24%. So over the course of the week, the average sector lost 2% of its issues and uptrends, moved a little bit further to the left, meaning that we're skewed to the point where very few stocks in these sectors are performing well. A couple things to take away here. Oil and oil service continue to be basically the best sectors from a breadth perspective. Insurance, we talked about insurance now for months, for whatever reason, behaving better than the rest. And then some important economically sensitive groups: transports, banks, aerospace, builders, machinery, Wall Street, at the right side of this group. At the far left side, some of the more defensive sectors like healthcare, some of the highest multiple stocks, and that would make sense that high multiple stocks corrected the most: semiconductors, biotech, Healthcare have been around the weakest. Now, I just want to compare this briefly to what we were looking at October last year. At the worst point of the bear market last year, at the bear market lows, the average sector had 20% of stocks in uptrends, even a little bit more skewed to the left here. But interesting, still at that point, transports, oil and gas, banks, oil service were among the best. So leadership has really not changed very much. And as is often the case, the higher multiple stocks were hit the hardest at the worst point in the correction last year. So we haven't turned up yet. It'll look very similar to what it looked like in the middle of October last year. We started to see some divergence in some of the market internals. Let's take a look at the leadership groups. Energy continues to lead. And I understand there's some view that it may be driven partly by what's going on in the Middle East, the tragic circumstances there. But this has not just happened since we saw problems in the Middle East. We've seen a move higher since reflation began in 2020. Energy companies held in remarkably well through the tightest and fastest interest rate cycle that the Fed has ever put us through. And when the market started to sense the Fed could be done, energy producing shares started moving higher. We're trading very close to relative strength new highs. Uranium producers are the same, moved smartly higher out of the summer, and they corrected a little over the last few weeks, but have maintained a lot of strength. Companies like NextGen and Cameco, acting remarkably well. So energy continues to be an important group. They generate tremendous free cash flow. They have a great opportunity to raise dividends. So we're going to get dividend growth. We're going to get earnings growth. And as a result, we're seeing share prices behave very well. We're seeing M&A take place in the group. Now, technology has led really since the beginning of 2022. From a price perspective, broke down in July, traded sideways here in a zigzag pattern over the last 3 months. You can note that the relative strength versus the S&P has remained pretty strong. Still trading better than 90% of stocks in the S&P. So really there hasn't been a significant break here. Some stocks better, some stocks worse. But in particular, the largest of the large caps have performed the best. And I think the rationale behind that is these companies all generate cash. None of them need funding. None of them need to worry about the fact that interest rates are higher in the economy. And they all have pretty solid franchises. So this group continues to hang in pretty well. Insurance, we saw that on the sector chart, insurance really at the top from a breadth perspective. And you can see in particular, the property and casualty companies trading above all the long-term moving averages. And we have a host of companies in this group that we've highlighted over the last few weeks. From a banking perspective, we continue to be cautious. This is the equally weighted Canadian bank ETF. So for the big five banks, an equally weighted basket is down 30.1% over 448 days. I know that this is a group that is well loved, and certainly we did own some along the way, slowly pared our way out. We do continue to have JP Morgan and the US large banks. It's really the only bank exposure that we have, and we're sitting very close to relative strength lows. We'll see whether some of these lows hold, but I think obviously there's concerns around mortgage renewals and what that might mean with a consumer that's a little bit stretched. Moving away, industrials. So this is, again, a chart back to 2020. This is one of the only groups in the market that made a new high post the highs in December of 2021. So this has been a market-leading group. We broke trend, trade higher, and through this most recent corrective pullback, and we're testing the top part, the support from the last 18 months. But again, on a relative basis, that's a good looking price pattern. And if we compare the equally weighted industrials ETF BIS to the equally weighted S&P, a very clear relative uptrend since 2022 lows. In fact, since before the market lows in October, the relative strength of industrials bottomed in June. The stock market didn't bottom until October, and they've been relatively outperforming ever since. So a takeaway, generally the leading groups start to perform better than the market before the market makes its low, That's strong relative performance. And when the market corrects, holds its relative performance versus the market. And that's exactly what the industrials have done. So from a longer term perspective, this is an interesting group. I looked at the equally weighted industrials for a reason. There's some very, very large defense companies that make a difference in the broader index, and defense stocks, as you can imagine, are trading better than the equally weighted S&P, and certainly have had a lift over the last 2 weeks. So industrials continue to be leadership group. Materials certainly pulled back a little over the course of summer. This is the relative strength chart versus the equally weighted S&P. Made its low in 2020 and has been making higher lows ever since. This has made a relative low again. July of 2022 made a relative low and started moving up versus the S&P prior to the market's low in October. Made a higher low early in 2022, made a higher low in October, made a higher low in March of this year, and again have been holding relative strength. So again, some leadership here. Foran Mining, one of the companies that I think really stands out in the mid-cap metals producers. This is making an absolute and relative new high today. Moving on, high dividend paying stocks. We keep getting asked about this. This is the FDL ETF. It's made out of dividend aristocrats, company that have had a history of paying a dividend without cutting. They tend to be high dividend paying stocks, not dividend growth stocks. Companies that generally are very mature and have lots of cash flow, but don't tend to grow very much. This is a group that people tend to pile into when they're worried about the economy. And as you can imagine, lots of defensive investors surprised by the fact that this ETF pulled back 19.5% since April of 2022. So we'll see. Not really showing any technical improvement at this point, and certainly not improving relative to dividend growers. So when we put that all together, we don't look much different than we have, except you'll see that we now have about 17.5% that we have allocated to short-term government bonds. Now, essentially, these can be seen as cash. We can take them and use them at any given point in time. If bond prices start to improve, there probably are other assets that will do better. But for the first time, we are getting paid well, and we have started to see some of those divergences that I pointed to in the bond market. So firm-wide, we're about 17.5% short-term government bonds. What I mean by that is 2 to 3 years. It doesn't mean that if we start to see improvement in the bond market, we wouldn't extend that term. But at this point, we're committed to 2 to 3 years. Energy continues to be our largest sector weight, has been for quite some time. Technology is a significant weight, although we do think that there are other sectors that could provide us more if we wind up in a little bit better environment. Financials continues to be focused in insurance, a little bit overweight versus the S&P. We continue to have a pretty significant cash weight. And between cash and corporate bonds and short-term governments, we're about 30% across portfolios, which just reflects the fact that we are defensive, as we tend to be, until we start seeing some improvement in those breadth models. So there are no groups that we can point to that are newly emerging leadership. There are the existing groups that we've focused on for quite some time. There clearly are some weak groups in the market: real estate, utilities, consumer discretionary, telecom, consumer staples, and healthcare. All are groups that tend to be seen as defensive, tend to be seen as groups you would want to own if the economy is really going to weaken. And I know there's people who believe that that's going to happen, but there's no price action yet that supports that. So it's a bifurcated market. It's a very targeted market. We've been working hard at playing defense. Clues that I would take away that are sort of ancillary clues. Volatility. Volatility often spikes in October, as it did in 2020, did in 2021, in October of 2022. Very muted response, given the fact that the S&P sold off 10%, the equally weighted sold off 13%. and we're getting a significant reversal here in volatility at the end of the month. So I take that as a positive. When we look at credit, the extra return a bond investor expects to receive from either a BBB corporate bond or a high yield buyer, really, they have not been increasing the spread that they're looking for in buying bonds. That means that bond investors are not overly concerned about credit risk. Again, something that you would watch for if you thought the economy was going to significantly weaken. Now we're halfway through earnings. 281 companies of 500 have reported. The average company has beat the estimates by 7.8%. Now, albeit earnings estimates have been pulled back coming into the quarter, but this is one of the most significant earnings beat quarters that we've seen over the last few years. I take that as a positive. When we look at the aggregate of economic indicators, this is an indicator called Citigroup Economic Surprise Index. Takes the summation of all the major economic releases and looks at whether the numbers are beating or missing. Since October of 2022, in general, the estimates, the surveys, the reports are coming out better than the surveys are expecting. We watch for sign that that's changing. So between credit and between earnings and between economic surprise, when we look at some of the divergences in breadth, we're a little bit more optimistic, but we'll see. Now, it's been a difficult period from October the 26th to the beginning of this week. Tough time for the TSX down 8, equally weighted S&P down 13, dividend aristocrats down almost 13, long end of the treasury market down 15%. Interesting outlier, commodities index up 1%. Portfolios, came under a little pressure, down between 4 and 6%. But given what's happened in the equity indices and the bond market, actually feeling pretty good about that. We mentioned last week, we're headed into a stronger period in the year. Today was not a bad day. It looks as though a lot of the selling coming into mutual fund year end is done. We'll see what happens in the month of November. Now, I mentioned in the beginning, there's lots of stats. When you came out of October and it was down, but the market was still positive on the year, November and December tend to be quite positive. Final 2 months positive 89% of the time, an average of 4.8%. So we'll see. We have been looking for the fact that we're getting close to exiting this long bear market. We'll see when we ultimately do make a new high. If things start to improve, we'll look forward to the next run, because the reason we're all invested is because after cyclical bear markets, you get cyclical bull markets, and they tend to be significant and they go on for 2 to 3 years. Our job is to protect through declines. Our job is to have some cash when things are sloppy. And our job is to look for new signs of leadership that will emerge as we get into the next leg of this bull market. If things get more difficult, we can always have more cash and we can always have more bonds. But at this point, we're comfortable with the structure of the portfolios, and we look forward to exiting the month of October. So don't hesitate to follow us on Twitter. Don't hesitate to go to our website. We're posting lots of content there. We're happy to push it out to you if you'd like to have it. I'd love to answer any questions that maybe you might have.
Thanks so much, Dave. We just had one question from one of our favorite viewers, Stephen in Toronto. He was curious. David, the bull market now looks like a bear rally. What are your thoughts on that?
Yeah, I'm not on that page, Stephen. We'll learn a lot over the next month or so. I'm not sure that that's the case. Certainly we have lots of times when October feels bad. If this is just a bear market rally, then you should expect those few leadership groups that have held their leadership position to start to fail. And we're not seeing that. as cautious as I have been about large cap tech, it's held in, and in fact, relative strength, as you saw earlier, is sitting at 90%. The materials group, if we were in a just a bear market rally, should be collapsing, but that hasn't happened. Industrials should be in real difficulty. Now we'll see what comes over the next few weeks. But that being said, we aren't seeing real signs economically. We aren't seeing signs from a market perspective that this is over. If the market starts to believe that we are rolling over out of a bear market rally, then you should expect to see a sizable bond market rally. But really, at this point, I can't point to that. So we'll keep watching for signs, but I do not think that's the case.
Thanks so much, David. Rajiv has a question here. He says, Dave, excellent presentation as always. What's your take on Apple?
That's a great question. We're all going to see what the earnings look like over the next couple days. Look, it's been under a little pressure. It's sitting just below the 200-day moving average. It's sitting just above the lows from September. Technically, it's at an important spot. It's had a pretty sizable pullback from July. I mean, sizable for Apple. It's about 10%, I think. Let's just take a look. So off the highs, yeah, it's down 12%. So it's down about what the equally weighted S&P is. It's an important stock. One of my concerns is that the earnings growth is relatively low compared to the multiple it trades at. But they do have a history of making their numbers. So I think that will tell us a lot when they report. And we'll see what comes. It wouldn't be my first position that I would be adding to.
Thanks so much, David. Well, that concludes the questions for this evening, and I feel like you've given our viewers a lot of treats in their Halloween bag this evening. So on that note, I'll leave you with a spooky final last word, and happy Halloween to everybody.
Yeah, look, it'll be a treat if we see a better November, and we'll see. We're not making any big bets. Our first job is to make sure we don't lose a bunch of money. So we do have a lot of dry powder. We'll see. If we see those bread models start to improve, we will act, because that's what we do. If things get worse, we'll get more defensive. You can't manufacture a return if there's none available. What you can do is you can protect on the way down, and that's something we've worked really hard at over time. And we always are trying to learn from our mistakes in the past and just make sure we stay disciplined. So with that, if there's any other questions that you were afraid to ask, don't hesitate to call. If you're a client, want to have a conversation with the portfolio, I'm very, very happy to jump on the phone and give you very specific information about your portfolio. And if you're not a client and would like to ask questions anyway, give us a call. We have about 300 families that we take care of, and we probably could always deal with a few more. So Pam, thanks so much. I hope your trick-or-treating goes well. Thanks everybody for joining in.
Thanks, Dave.